Are you confused about fixed stops versus trailing leashes? Let's break it down. Bailing at $90 or locking gains at $108? It's all about planning your trade and sticking to that plan. Watch closely to see when each stop can actually help you. Stay tuned to learn the key differences and maximize your gains.
Gary, let's get into it. Educational topic to close out this week, trailing versus fixed stop losses. First, Gary, let's just talk about what's a stop loss.
So, Rob, a stop loss is something that some investors will use when they want to make sure they don't have a possibility of taking a big loss in a name. They'll own a stock and they'll set up a system where if the stock drops by a certain amount, they will automatically sell it. Now, keep in mind, this is the opposite of that old Wall Street mantra, that old saw, you want to buy low and sell high. This is you buy it, hoping you can sell it higher. But if it falls, they're actually going to sell it before it falls a lot. Now, that won't help in situations like we were just talking about Supermicro, which dropped 20% all at once. If stocks gap down, it won't help you. But a stop loss is where an investor, when they buy a stock, they put in an automatic sell order where if the stock drops by a certain amount, they'll sell it. They're saying, you know what, I will take a 5 or 10 or 20% loss rather than risk something going down 50% on me.
Gary, let's talk about a fixed stop loss now. What's a fixed stop loss compared to just a traditional stop loss?
So a fixed stop loss is where you fix that sell point at the time of purchase. So let's just give an example. Let's imagine an investor is buying a stock. The price of the stock is $100 and they want to use a 10% fixed stop loss. They would automatically sell the stock if it declined to $90, right? And that $90 is fixed. So assuming the stock doesn't gap down, what that means is that the maximum loss that they could take in any given name, in that particular name, would be $10 or 10%.
Next one, Gary, going down the list here. Trailing stop loss for our audience. What is a trailing stop loss?
A trailing stop loss is one that will adjust with upward price movement in that same stock. So let's use the previous example we had of a $100 stock. And this time there's going to be a 10% trailing stop loss, not a fixed one, a trailing one. So now let's further imagine the stock rose to $120. A 10% drawdown from there would be $108. That means the stock in this example would automatically be sold if it dropped back down from 120 to 108. The fixed stop loss, it would have to drop all the way to 90 to be sold. In the trailing stop loss, in this example, you'd sell it at 108. And again, they put in those orders ahead of time so that they're executed automatically.
Gary, why don't you give us then an example? Why would someone use a stop loss? What does a scenario look like in that situation? Someone would want to be using these strategies.
So I think the key thing is you need to know what your risk tolerance is and how that impacts your investment thesis. If you're a short-term trader, or if maybe you have a lack of confidence in your thesis, or maybe you don't know what's going on in a particular name. There are a lot of people who buy stocks, a friend told them something. They don't really know why they own it other than someone they like told them about it. A stop loss can be an effective way to limit losses, particularly if you're on tight risk tolerances. A lot of times, investors who are using a lot of leverage or margin will use stop losses because when you're leveraged, as we talked about in last week's 5 things, you run the risk of losing money on a larger amount of capital and having to pay interest expenses. So a stop loss can be a way to ensure losses, but it can also be a way to ensure you don't take big losses. A lot of the highly leveraged shops, places like, Citadel or Millennium, where they use a lot of leverage, they're using a lot of capital, they worry a lot, understandably, given their balance sheet, about taking big losses. And so in a place like that, they're okay with you buying a stock at 100, selling at 90 and buying it back at 100. And somebody might say, well, wait, they just took a $10 loss. Yeah, but they ensured that the stock didn't go to 50. And so that's why you would do it.
Gary, do you use stop losses? So is this something that you deploy within your strategy? If not, why not?
Almost never. I really don't use them. And the reason is because I'm a long-term investor. And if I'm investing in something, I almost certainly have a really well researched thesis. I often view price declines as an opportunity in a situation like, we talked about, where if I like a stock at 100 and it drops to 90 or 80, and I understand the reason why, and I disagree with the reason why, and my investment thesis is still intact, I view that as an opportunity to buy more at a lower price. As an example, on more than one occasion, one stock that we've owned that's been really volatile is Las Vegas Sands. The ticker is LVS. On more than one occasion, we've bought that stock when it declined on news that we considered to be unimportant or temporary. This is something we covered in last week's 5 things. And so, the stock drops. And as long as I understand that the reason for it is long term unimportant or temporary, we just buy more of it at lower prices. When the stock recovers, we're making money on a larger amount of capital on more shares. We bought it lower. So, look, the key thing is that somebody might say, well, wait a minute, you're buying it on the way down. If it keeps dropping, you're going to have more capital. There's risk to that as well. There's no path through that entails no risk, but you have to know what your investment thesis is, what your investment philosophy is. And in my case, if I'm owning something for the long term, if I have a really well researched investment thesis, if that thesis is still intact and I understand the reason the stock has dropped and disagree with it, I'm going to be buying more, not selling it on that drop. And that's what works for me.
Yeah, no, that's great. I actually was reading a strategy the other day. It was talking about diversification, where your weighted portfolio sits, and it was talking about just the group of tens, right? Where 10 stocks, whatever you would put into those 10 stocks, put a tenth of that, right? And then you're allowed to buy up to your, whatever your full allocation is, to where you're actually almost rooting in a way for that stock to go down early on, pick up more shares if it is longer term investment. Or, okay, if you do start making money on that 10%, obviously sell, get back original investment, ride the profits, right? So interesting strategy, a lot of different ways to do it. But yeah, Gary, I would agree with your approach. We're always looking long term investment thesis, right? Those for us are more so opportunities. I don't want to be caught in a situation where I have a stop loss set up, all of a sudden, boom, it hits that lower limit and I accidentally sell, when in reality, if I really did like the stock, I'm going to be wanting to buy more of the stock when it hits that particular limit. So anyways, Gary, great show as always. The you're fired issue, you're not fired, hopefully I'm not fired, we'll both be here back next week. So no one on this show is getting the you're fired. We made it through to another week. So Gary, I'll turn it over to you. Final thoughts. Head on over to deepknowledgeinvesting.com. We'd love for you to join our community that we're building. We got a lot of fun, new, exciting stuff.